Did you know that even as a minor you can start investing? That's right, age is but a number when it comes to dipping your toes into the world of financial markets. The potential and possibility of investing at a young age is immense. Starting early is like planting a seed. It might take some time, but it can lead to blossoming financial stability in the future. So don't think your age is a barrier to start investing. It's all about taking the first step. Before we dive into the how-to, let's understand some basics of investing. Investing in its simplest form is the act of committing money or capital to an endeavor with the expectation of obtaining an additional income or profit. It's like planting a seed today so that you can enjoy the fruits tomorrow. Now, there are several types of investments, each with its own set of characteristics and levels of risk. Let's discuss a few of them. First, we have stocks. When you purchase a company's stock, you're essentially buying a small piece of that company. As the company performs well, the value of your stock increases, and you can sell it for a profit. But remember, the opposite is also true. If the company doesn't do well, the value of your stock may decrease. Next, we have bonds. These are like IOUs. When you buy a bond, you're lending your money to the issuer, like a government or corporation. In return, they promise to pay you back with interest at a future date. Bonds are generally considered less risky than stocks, but they also have lower potential returns. Then there are mutual funds. These are investments that pool money from many investors to purchase a diversified mix of stocks, bonds, or other assets. This way you get to spread out your risk across a variety of investments. Now let's talk about risk and reward. The potential for higher returns comes with a higher level of risk. This is the risk-reward trade-off. There's no such thing as a free lunch in investing. If you want the chance for higher returns, you'll have to accept higher risk. That's where the concept of diversification comes in. By spreading your investments across different types of assets, you can reduce the risk of losing all your money if one investment performs poorly. With these basics in mind, we are now ready to explore how a minor can start investing. While minors can invest, there are some legal aspects to be aware of. In the world of investments, age isn't just a number. It's a factor that can determine your rights, responsibilities, and even the type of account you can open. So for our young potential investors, let's delve into the legal side of things. One of the primary considerations is that minors, in most jurisdictions, cannot directly own stocks or other securities. This is where custodial accounts come into play. A custodial account, as the name suggests, is an account managed by a custodian who is typically a parent or a legal guardian. This account allows minors to own investments indirectly. There are two main types of custodial accounts: the Uniform Gifts to Minors Act, UGIMA, and the Uniform Transfers to Minors Act, UTMA. The UGIMA allows minors to own securities like stocks, bonds, and mutual funds, while the UTMA also includes real estate and other assets. It's important to note that the custodian is responsible for managing the account until the minor reaches a certain age, typically 18 or 21, depending on the state. This means the custodian makes all the investment decisions, but they must act in the best interest of the minor. However, once the minor reaches the age of majority, they gain full control over the account and its assets. It's their show from that point onwards. They can choose to continue investing or withdraw the funds with no restrictions. One thing to keep in mind is that these accounts could have implications for financial aid when it comes to college. The assets in a custodial account are considered the minor's assets, and this could potentially reduce the amount of aid they qualify for. Navigating through the legal aspects of investing as a minor can seem like a daunting task, but it's worth it. Understanding these complexities can help ensure your financial journey is on the right path from the get-go. While it may seem complicated, these legal aspects are crucial to ensure your investments are safe and secure. Now that we've covered the legal aspects, let's talk about choosing the right investment. This is where you get to roll up your sleeves and dive into the fascinating world of finance. Firstly, it's crucial to understand that not all investments are created equal. Each one comes with its own set of risks and rewards, and it's your job to find the one that best aligns with your financial goals. Are you saving for college, a car, or maybe you're just looking to grow your wealth? Your answer to this question will largely determine the type of investment you should go for. So, how do you start? Research is key. This means investigating different types of investments such as stocks, bonds, mutual funds, or real estate. You'll need to understand what each one is, how it works, and the potential risks and rewards involved. Let's say you're considering investing in stocks. You'll want to look at factors like the company's financial health, its track record, and its potential for future growth. You might also want to consider the overall health of the industry it's in and the state of the economy. But remember, investing isn't just about facts and figures. It's also about intuition and gut feeling. If something doesn't feel right, even if the numbers look good, it might be best to steer clear. Next, consider your risk tolerance. This is a measure of how much financial risk you're comfortable taking on. If the thought of losing some money keeps you up at night, you might want to stick to safer investments like government bonds or high-yield savings accounts. Lastly, don't forget about diversification. This is the practice of spreading your investments around to reduce risk. It's like the old saying goes, don't put all your eggs in one basket. Choosing the right investment is a crucial step that can have a significant impact on your financial future. So take your time, do your homework, and make sure you're comfortable with your decision before you take the plunge. Ready to take the plunge? Let's discuss how to get started with investing. The first step in your investment journey is opening a custodial account. This account is a type of brokerage account that's established by an adult, typically a parent or guardian, on behalf of a minor. It's a simple process that can usually be completed online. You'll need to provide some basic information about both the adult and the minor, such as social security numbers and dates of birth. Once the account is set up, you're ready to make your first investment. This is a significant step, so take your time. Research is crucial. Look into different investment options: stocks, bonds, mutual funds, exchange-traded funds. Each one has its own risks and rewards. Consider your financial goals and risk tolerance. Are you saving for college or building a nest egg for the future? Do you want to take more risks for potentially higher returns, or are you more comfortable with steady, lower-risk investments? After you've made your decision, it's time to buy. Depending on the brokerage, you may be able to do this online or over the phone. You'll specify what you want to buy and how much you're willing to spend. Investing isn't a set-it-and-forget-it activity. It's important to regularly monitor your investments. The market is constantly changing, and you'll need to adjust your strategy accordingly. This doesn't mean you should panic every time the market dips. Ups and downs are part of the investing game. But if your investments aren't performing as well as you'd like over the long term, you might need to make some changes. It's also a good idea to keep learning. The more you understand about investing, the better decisions you'll be able to make. Read books, take online courses, follow financial news, use every resource at your disposal to increase your knowledge, and there you have it, a simple guide to start investing as a minor. Let's quickly recap what we've discussed today. We've unraveled the possibility of investing even as a minor. While it may seem a daunting task, with the right guidance and understanding, it can become a fruitful endeavor. Remember, it's not about how much you invest, but rather how early you get started. We then dove into the basics of investing, the cornerstone of any successful investment journey. We touched upon the importance of understanding the market, the various investment options available, and the potential risks involved. It's all about making informed decisions. We also shed light on the legal aspects of investing as a minor. While there might be some restrictions due to age, there are ways around it, like setting up a custodial account. It's crucial to abide by the law while chasing your investment dreams. Then, we explored how to choose the right investment. It's not a one-size-fits-all scenario. What works for one might not work for another. Your investment should align with your financial goals and risk tolerance. Finally, we discussed getting started with investing. It's all about taking that first step. Do your research, seek advice if needed, and make your move. It may seem intimidating, but every successful investor started somewhere. Remember, investing at an early age can set the stage for a financially secure future. So don't wait. Start your investment journey today.